Today we consider possibly the easiest trading strategy you've ever seen. Now this isn't one for gold bugs or anyone that has an outright aversion to stocks. This is one coined by the great Bill Bonner, which involves using one indicator, just one indicator, the Dow Gold ratio, and making one trade every decade or so. Now let's dive on in. Now this channel provides global macro insights for informed investing, so do consider subscribing. So the Dow Gold ratio simply measures the Dow Jones stock index against the prevailing price of gold. Effectively, this tells us how many ounces of gold it takes to buy the Dow Jones. Thus, 10,000 Dow and $10,000 gold would give a ratio of 1:1. When the ratio is high, stocks are expensive relative to gold. This is the ideal time to start acquiring gold. When the ratio is low, stocks are cheap relative to gold. As I record this now in May 2020, we can see that there is a ratio of 14.34 to 1. In previous big crashes, we've seen this ratio hit 1.94, 1.29, 6.36 back in August 2011. So Bonner uses this approach to determine when he should get in and get out of stocks. When the ratio goes above 15, he sells his stocks and buys gold. When the ratio reverts back to 5:1, he sells his gold and buys stocks. Thus, when it takes 15 ounces of gold to buy the Dow, he buys gold as it is cheap relative to the Dow Jones index. When it takes just 5 ounces of gold to buy the Dow Jones, he sees stocks as cheap relative to gold. Now imagine we went back just over 100 years to 1918 with just over $200 and bought 10 ounces of gold for $206.70. Your first action is to sell the gold when the Dow Gold ratio is 3.7 to 1 and buy stocks. By February 1929, the Dow Gold ratio hits 310 and gives a ratio of 15 to 1. Thus, you sell your stocks and buy gold. This gives you $1,463, thus giving you a 608% return, including the reinvestment of dividends, or a 310% return without since 1918. This enables you to purchase 71 ounces of gold. In September 1931, you sell your gold for the Dow when it's at a value of 99.8. While the gold price has remained unchanged, this strategy avoids the worst of the Wall Street crash, and your gold is sold for $1,463. In September 1958, the Dow hits 510 points and the Dow Gold ratio hits 15 to 1, triggering your sale of stocks for gold. Yes, I know it was illegal to hold private gold holdings at this time, but let's just imagine it's not. You've now collected a $31,084 return, including reinvested dividends, offering an upside of 2,025% from 1931. Excluding dividends, Bonner states the return is just 430%. We then buy gold for $35. By April 1974, you buy back into the Dow, selling your 858 ounces. Meanwhile, the Dow Gold ratio is at 5:1, with the Dow at 840 or so. Having come off the gold standard, the gold price rocketed to $169.50 per ounce, and it gives you $150,105 to put into stock. In July 1996, you sell out of stocks with the Dow Gold ratio of 15 and buy gold for $382. You sell out of the Dow when it's valued at $5,730 for $2.57 million, giving you a 1,614% return with dividends reinvested from when you purchased the stocks in 1974. The return excluding dividends is 549%. You then buy 6,734 ounces of gold priced at $382 an ounce. This means you endure a bear market in gold culminating in Brown's bottom, but you also sit out the dot-com crash and the 2008 financial crisis. But you also enjoy a remarkable bull run for gold between 2002 and 2011, and that turns your $2.57 million to $8.4 million. With the Dow Gold ratio failing to actually hit 5, your position remains firmly in gold right now. Thus, from your initial $206.70 investment in 1918, you've now amassed $8.4 million over 102 years. This gives a total return of over 4 million%. Now, the annualized return on this strategy would have been just over 11% per year. By comparison, a simple buy and hold investment in the Dow from 1918 to now would have yielded an annual return of 10.44% with dividends reinvested. The gain on remaining solely in stocks would have been $4.26 million. Similarly, if we had held gold from 1918 to today, our original 10 ounces of gold would now be worth just $12,310. So Bill's strategy is based on a simple premise. You make money by buying stocks when they are cheap and selling them when they are expensive relative to gold. And that's how you turn $206 into $8.4 million over the course just over 100 years. Could you do something similar right now with silver? Well, it's possible. By looking at the Dow Silver ratio, we can see that silver has tended to generate poor long-term real returns, so we would need to use ascending tram lines to actually fit this against the movements of the stock market and insulate us from stock and silver crashes. What do you think of the prospect of this strategy working in the future? I know many of you, like myself, have deep misgivings about the financial system, yet it remains the bedrock of many people's pensions. I'd love to hear your thoughts in the comments below. Do consider subscribing, hit the like button, and I'll look forward to seeing you next time. Bye bye.